chaired by Russ Mould. The discussion is investing in different sectors and markets. Also with Russ is Croft. He's the CEO of Stockopedia. Hector McNeil, he is the co-CEO of Boost ETPs. And Brenda Kelly, she's the Chief Market Strategist of IG. So, Russ, over to you.
Right, everybody, thank you very much for your time. What I'm going to do here is I'm going to let these three people say who they are, why their firms are, what they're doing out there, where you can find them, and how wonderful they are, why you should listen to them for the next half an hour. And then I'm actually going to throw them to the wolves, i.e. you lot, and let you ask some questions. Because I've got a long list of questions here. But they're all really, really easy ones, like where do you live, what's your favourite meal, and all that sort of stuff. Which is fascinating for me, but it's absolutely no use to you at all. So if you all go shy, I'm going to ask these. But in the end, this is an opportunity for you guys to learn, find out what you want to know from three experts in their field. So in terms of the introduction, I'm going to start, not with the lady, sorry about that, because Ed's bumped in front of you with a couple of slides. I'm going to start with some slides from Ed, then go to Brenda, and then go to, with correct pronunciation from Yorkshire, Hector, without the H.
Okay. Yeah, my name's Ed Croft. I run Stockopedia.com. I was formerly a wealth manager in the city and then just a motivated private investor who happened to turn his hobby into a business. So essentially, you wanted me to go into some of these slides?
You're welcome.
Okay, this is obviously sectors and markets panel discussion. One of the first things I wanted to say is that it's very important that one is invest based upon rules. And one of the key rules that works very, very well, as you just very clearly pointed out, is that investing in cheaper assets has a tendency to outperform expensive assets. And this works across markets and sectors in just the same way. If you chase returns, if you go into hot sectors and hot markets, you tend to find you have more average returns. We're all here to try and find above average returns. And one of the really key ways of looking at markets around the world is a factor called the cyclically adjusted P/E ratio. This is basically a P/E ratio that is using average earnings across multiple business cycles. So you can create a P/E ratio that's kind of independent of the current state of a company or a market. In other words, if earnings can be very elevated in a boom, or they can be very low in a decline. And I've created a map using some data from a really great book by a chap called Mebane Faber, if I can flick forwards, which shows the global cyclically adjusted P/E ratios across different markets around the world. So green, you can see, means cheap, and red obviously means more expensive. And I think this gives a very visual indication of where the cheaper assets are in the world. Some would obviously expect places like Russia to be quite cheap. But you can see here that, for example, America has had this great boom and lots of money's been flying into it. And you can see Southeast Asia, India is also quite expensive, little isolated one of Denmark up there. And in general, the cheaper assets have a tendency to be actually some of the BRIC nations, Brazil, Russia, China, and what you might know as the pigs, Portugal, Ireland, Greece, etc. Things like the UK are much more moderately valued, and so by this way of looking at the world, you can see where potentially over the next few years some of the returns might accrue. And I've got a couple more here. This zooms in on Europe. This actually uses, this is our own proprietary value rank, but again you see a similar story that some of these peripheral European nations are a lot cheaper. You can see the Balkans, which again are quite hard to trade for private investors, also Greece, Portugal, etc. And if you take some other factors into account, you can see that Central Europe is actually potentially looks a bit more positive than the others. Anyway, I just wanted to say that about geographies now. I can save the sector slides for later. Maybe if you...
Absolutely. Brenda? Follow on from that, just quickly say who you are and why you are and how wonderful you are. Brenda, that's what your clients are interested in right now as well.
Okay, well, I'm Brenda Kelly. I'm Chief Market Strategist at IG. Now, we're normally quite known for more FX, spread betting and CFDs, but we are actually launching a new stockbroking product as of this week, which is primarily why we're here. But we have seen a great deal of interest, really, I suppose, over the last number of months in the healthcare sector, and you could obviously look at that as one of the better performing FTSE 350 sectors over the course of the year. A lot of that's been down to the likes of, I suppose, M&A activity, and I suppose in some respects it had a little bit of catching up to do as well. But ultimately that seems to be where a lot of our longer term investors, whether it be margin trading or non-margin trading, seem to be very much involved in at the moment, and I don't expect that to change for the time being.
Hector.
As Russ said, I'm a token northerner in the room as well. I think he just put me next to him to dull out the accents a little bit. My name is Hector McNeil. I'm co-CEO of Boost, exchange traded fund provider. I've been in ETFs since the start. They've been pretty much one of the major revolutions in financial services over the last 20 years, accruing nearly $2 trillion of assets globally and growing. What they really do is, the interesting slides there, one of the main ways you can actually access all those countries in a very efficient and liquid way is through ETFs. And you can pull a very balanced portfolio together for very low fees, and actually getting lower by the day. There seems to be a race to the bottom when it comes to fees. So I think it's going to be an interesting discussion, not only on where to invest, but how to invest as well.
Now, I've just made an impassioned case for focusing on bottom-up investing, which is what I was trained to do as a fund manager and a Warburg guy. But equally, to what degree is it possible, or can people, I mean, let's face it, there are 3,000 companies in the UK alone. To what degree can you use macro, country, sector to then filter down to companies? Or do you not need to worry about the companies at all? Alan Miller doesn't with his fund of ETFs, for example. So how would you guys sort of look at that? Well,
interestingly, when I go out and talk, I mean, we have listings all over Europe, and previous companies I've been involved in, we've got listings all over the world. And it seems to be the trend I'm finding with wealth managers or people who are actually investing in ways you're talking about there, is that they tend to use ETFs for markets where they're not that close to. So if they're talking about the American market or the Far East market, and they tend to invest more in stocks in markets they understand. So if you took a UK wealth manager, they're more likely to invest in UK stocks, individual stocks, and use ETFs for the more faraway markets that they don't really understand. Being the mantra that if they hear about a stock to trade in, they're probably the last guys to hear about it.
Brenda?
Well, I suppose in some respects...
the FX must be pretty macro anyway, isn't it?
It is a lot of macro, and I suppose over the last number of months, up until I suppose the last couple of weeks, we've seen a distinct lack of volatility in both the FX and even equity space to a degree. But I think a lot of us have been coloured. If you were working in the markets, as I was in 2007 and 2008, it does change your perspective on what a correction actually is. And any sort of fallbacks in equities that we've seen over the course of the last month has been interesting to watch. Some of the rookie traders coming on board where they think all hell has broken loose, and yet we've only maybe lost about 5%. I remember watching that in a matter of minutes back a few years back. But there does seem to be a propensity out there as well to try and call a top in these markets, and that is what is probably coming from the 2008 crisis. And yet we seem to have no real stopping to it for the time being. You could say, as we pointed out, there are a lot of countries that are a little bit overvalued, but there's certainly definitely some opportunity left within the FTSE 350, as opposed to that maybe in the US.
Ed?
Well, I think a lot of people are scared to go and pick stocks in other countries because they don't really have any information on them. And while I think, yes, ETFs are a very good approach, if you were going to take a CAPE strategy, it's much easier to invest in the general return of markets using ETFs. But I think, if somebody who actually wants to own shares because you want to own the underlying and you believe you can outperform the market by actually buying standout stellar shares, you should be looking for and trying to find research tools to do that. Obviously, I'm talking my own book here because we do have coverage of all the individual shares in Europe and the US, and I hope next year the world. So I think it's getting easier to do, but obviously the difficulties of trading international shares is you do have to deal with some of the FX charges. You do have to deal with finding a broker who can trade, for example, the Balkans shares, which is actually quite tricky. But if ETFs can be a very good way to go, there's a good article actually in the FT, which I should have linked to, which talks about the flying pigs, which is obviously all the Portugal, Greece, Italy, etc., and talks about how these countries are really coming out of their troubles, and they have been offering much more standout returns. And there's a few fund managers, European fund managers, who have put 50% of their portfolios in pigs countries. So I think a little bit of research, you can find sort of collective ways to invest in these rather than just necessarily the shares.
And Brenda and Hector, what do you guys offer in terms of research tools for your clients on sectors and markets?
Well, we would have screening tools as well, and a lot of research done by my own personal team as well, but on more of the major stocks rather than the more esoteric ones like the Balkans. We wouldn't really have those. But generally speaking, we would see a great deal of interest in checking out where the valuations lie, where the opportunities are, and I think everyone, as you could see in your presentation, has been looking for a bottom in this market or an opportunity to buy in on the dip, and that's a strategy that has been working to a great extent. When you look at the S&P 500 at practically 2014, the Dow Jones up around 17,000 as well. So there doesn't seem to be any real stop to this 5-year bull market, and it's just a question of having the opportunity to get in on any dip that might occur.
Hector?
Yeah, I mean, we offer a huge range of things, mainly focused on macro, but we also do weekly trade ideas. Because we offer both long and short products, we also have a big emphasis on hedging as well. We don't think it's all about just actually having a static portfolio.
Risk control.
Yeah, and it's particularly if you're going to use single stocks, because ultimately sometimes you might not want to exit those stocks if there is a bit of a fall in the market. So you want to actually just hedge yourself a little bit. So we offer the FTSE 100, 250, gilts, and various other products that you can use to hedge your individual positions. And the macro information is really there to help people do that decision.
Right, so now we can talk about everything from currency to Balkan politics. So I'm now, other than asking Brenda what her favourite champagne is and going through the softballs, I'd now like to go through to you guys and find out what you're interested in. So who's going to be brave enough to ask the first question, please? Gentleman at the front, please. If you could wait for the microphone, that would be great, because it's quite a big auditorium and not everybody's got quite such a stentorian voice as I have.
Hi, Ross. We met in Liverpool in 2008, and we were looking at the London Stock Exchange share price, which went down to £3.43. And we were predicting then it would rise to over £20. And it has risen to over 20, dropped back to 18.80. Do you feel that the London Stock Exchange share price is the best way to track the market?
Do I?
Yeah.
If you look at the chart, it's an extremely good way. And if you draw, you can, and JJ mentioned the number of flotations this year, again, without giving anything that we consider as financial advice, you can actually draw quite a good chart of the LSE share price against the number of floats. And it works quite well. And but then equally, if you really want to gear that up, you can look at some of the smaller quoted broking firms like Panmure's, Bruins, and again, because they're very, very fixed cost, all these expensive people that they employ, Hector. It's a bit like football clubs, generally speaking, investment banks. Great for the staff, not always so clever for the shareholders. But they're very, very highly geared. They have a very high fixed cost base. So secondary volumes are great, but where they make the money is on the flotations and the primary, particularly. Once those big deals come in that they charge 2.5% for, raising 50, 100 million bucks at a time, they're very highly leveraged into that. So in a bull market, they're very, very good leveraged ways of playing a rising market. Equally, the reverse applies in a falling market, I would suggest politely, if history is any guide. I mean, Hector, have you got anything on financial sectors that you can do there? Or?
I think it's just a question about the LSEs. I mean, I actually started my career at the LSE in 1989, actually. I was there for 5 years, and it's a very different beast today than it was then. It certainly wasn't listed then. I personally don't think it's a great way to track the stock market, simply because it's a very diversified business now. I mean, it owns...
More so than it used to be.
Yeah, exactly. It owns the Italian stock exchange, for example. So from that perspective, obviously, it's got quite a vested interest in that market. I mean, what's quite clear as well is the FTSE 100 in some ways doesn't track the UK market either, right? Because it's got lots of Kazakhstani and Russian and various other companies in it. Whereas something like the FTSE 250 could be seen as more of a real UK footprint. So you've got to be very careful on these things in terms of what you're actually trying to achieve. But as Russ says, there are plenty of interesting financial companies out there, and there are products that you can either go long or short the banking sector. So if you do have a view in terms of these very nasty investment bankers and what they're doing to you, you think that's going to come and bite them, then obviously you can short that as well as go long it.
And Brenda, do you see a lot of index action in your clients between, say, the 100, the 250, the 350? Do you see a different levels of interest there? Or?
You would. I mean, generally speaking, FTSE 100 would be one of the most popular indices that we would offer, and clearly it has even this month, it nearly made towards its all-time high that we saw back in 1999. But clearly, the weakness that we're seeing in China, and of course the Scottish referendum, which is clearly starting to rankle markets a little bit, has had a little bit of a negative effect on the FTSE 100. So that is probably going to be the interesting thing to watch in the near term. You also have the interest rate speculation from the Federal Reserve, also keeping a cap on markets for the time being. But there is always this possibility that when we haven't had volatility in the equity markets for so long, that you're going to have this reversion to mean, and that volatility will actually return. And we could, I suppose, see a repeat of the May 2013 taper tantrum that we saw when Ben Bernanke first mentioned tapering back QE. And remember, that is set to end in the US next month.
Is that right?
So we really don't know how the markets are going to react, but certainly you can chart quite nicely the S&P 500 against all the QE liquidity that has come from the Federal Reserve, and you do question whether or not that correlation will continue.
Thank you for the question. There was a lady waving her arm about sort of halfway back. I don't know whether she was waving at a friend or trying to get a... Quite no, she's gone all shy. Next question, please. There's a gentleman in the middle and a gentleman at the front, and there's 1, 2, and then 3, please. One in the middle, gentleman in the blue pullover by the look of it, and gentleman then in the black polo shirt. Thank you.
Thank you very much. My question is that there are plenty of brokers and advisors and everything else, and quite a lot of them make more money than the investors. How do you tackle that?
Straight ahead.
The gentleman's just there in the white shirt, Ed.
Right. Is that for me? Okay.
All of it. All of us.
Okay, yeah.
No, all of us.
Choose
We'll
the
all
guy
deal with
who's
it.
not the broker to answer it. No, absolutely.
No.
No, I can take a more independent view. I mean, obviously, one has to be very careful on fees. I think, the brokers all do much better in a bullish market, but they do obviously suffer when the liquidity dries up. Obviously, they're doing a service, and it is very competitive. So, sure, IG has a lot of scale, and I think a lot of the smaller operators, will suffer. I think, the service is getting better every year, and I think, one's seeing the cost driving down every year, and the more that people come into the market, and it's great to see so many people here today, the more that those people will compete for your revenues and trading revenues. So I think it's, over the long term, win-win. I think we're going to see a big growth of the DIY market, and we'll see more services and more competitors coming into the market. So I don't think it's all bad, but definitely you make a really good point, and it's one point I remember to bring up here. If you're switching between sectors and markets, you will be bringing transaction costs into your portfolio. And transaction costs, which can be anywhere from just a few basis points to a few percent, can be seriously detrimental to your returns. And every time you trade, if you're not in a tax-efficient account, you also could be taxable. So you just got to be really careful that you aren't giving away your portfolio to the brokers. And having been a wealth manager in a previous incarnation, I knew how great it was when people did turn over their whole portfolio. So just try not to. It is how they get paid, but it's not how you get paid.
I think transparency is very much key, though, particularly if you are investing overseas because of the FX risk. And you will see that a lot of brokers will charge quite a big premium for that. Now, not IG, I must add, but it is something that isn't necessarily all that transparent from some brokers. I have used several brokers over the course of my 25 years or so, and there has been, I suppose, a huge difference between what one company will offer and what on another. But you do generally get what you pay for as well. If you want a large suite of products to be able to trade and invest in, then it is probably worthwhile paying that little bit extra just to have it all in the one place.
I mean, to back up Ed's point, there's been a bit of a punch-up between the ETP providers this year in terms of fees. I mean, where's Boost coming out on that one?
It was certainly in what they're calling the core offering, which is the standard generic ETFs. There's what I call a race to the bottom. I mean, you can actually buy an S&P 500 product now for 5 basis points on an annualized basis with no entry or exit cost. Now, that's not a product we provide, but certainly that's happening out there. So there is a very, very competitive market. I also think the point about DIY investing is extremely important. There is a huge amount of systems out there, model portfolios, whatever you want to grab, that you can use to help you make your investment decisions, come up with diversified portfolios, make those decisions. One thing I would say is make sure you have the time to actually put into it and do a good job of it, because the one thing about advisors, if you don't have the time, they can do it for you and you've got someone to blame. If you do DIY investing, you've only got yourself to blame. So you must take your time and take your effort on that. And you know, lots of the rules that Russ came up with earlier, you know, be patient, you know, make sure you don't make knee-jerk reactions, make sure you don't churn your portfolio over too often. All those things are absolutely critical to making sure you don't pay too much money.
There's a gentleman in what looked like a blue pulley. And
Hi. My question actually concerns about ETFs, okay? I understand the principle of ETFs would be very useful to exploit, if you like, opportunities in you know, the pigs and so on, and as a way to diversify your investment strategy. But the question is really two things I want to like comment on. Number one is there are different ETF houses, you know, like Deutsche Bank have a whole stream, and there seems to be a lot of duplication, triplication of the same thing, okay? So how do you actually select like where you should go for a product, okay? For example, a Balkans product ETF. And the second question then is, a lot of ETFs don't seem to have a lot of volume. They may be quite sophisticated, but they don't actually have a lot of volume. I can't, obviously the S&P kind of ETFs have huge volume, but they're very gappy as a consequence if they're very low trading volume, okay? And how you can identify that and
so what makes a good ETP and liquidity, which obviously is a subject that JJ Justin touched on at the start.
I think the first point about selection of ETP provider, Europe's a bizarre ETF market because there are so many different regional companies involved. You know, you mentioned Deutsche Bank, obviously they were strong in Germany, you've got BlackRock strong in the UK, and SocGen strong in France, etc. So, but all those guys try to provide everything and obviously list them everywhere. There is great websites out there. There's one called ETF.com. They have a selection process on there. You can use CityWire or other people like that to go and look at them.
As which ETF?
As which ETF, yeah. So you can select it. So there's plenty of, and they're all free, which is great. So you can get all that sort of information there. Liquidity is an interesting one because actually the great thing about ETFs versus say like a mutual fund or an active fund is actually you do get liquidity. And actually I wouldn't get so concerned that there's no trading volume. Trading volume is not actually liquidity in an ETF because ultimately every ETF, the exchange will require them to sign an agreement with a market maker who is actually responsible for providing bid-offer spreads all day, every day. So they have to be there irrespective of whether there's volume. And basically, if their pricing ever gets out of line, i.e. they misprice the ETF either on the bid or the offer, they can be arbitraged. And that's a great beauty of an ETF, is it can be arbitraged. So the pricing's brought back in line very, very quickly. And the reason why they can be arbitraged is because they're open-ended. So the market makers can go and create and redeem the units to demand. So the liquidity that actually ETF gives you is actually coming from the underlying markets. So whether that's commodities, fixed income, currencies, equities, whatever, if the underlying market is liquid, therefore you get a liquid ETF. So, and one real important health warning here is if you are going to trade S&P 500, fantastic, massive liquidity. If you want to trade a frontier market Ghana ETF, it's a whole different kettle of fish. So just be aware that's the underlying market liquidity that's hugely important. And that's what differentiates ETFs from say something like spread betting or whatever, where you've got a single house providing liquidity. On an ETF, you've got 20, 30 different market makers who provide liquidity to that product. So you've got a very arbitrageable, open-ended, discoverable price process.
Okay, thank you very much.
Gentleman down at the front here in the black shirt. Thank you. Please.
Yeah, sorry, I got here late. My girlfriend dragged me here. The question I want to ask is it always best to do to invest yourself, or is it to use a broker? And the second question I have, forgive my ignorance, are you guys brokers, or what do you do?
The question is it best to go DIY or go down the advisory route? And I think that depends on your level of expertise and personal circumstances. Anybody want to quickly take that one? Ed, as somebody who used to work in the industry.
I kind of, I've done both, and I'd certainly say doing it the DIY way is certainly it's a way to reduce your costs, and I believe it's it is a good route to success as long as you do give it the effort that it requires. And I think just coming to a show like this and learning as much as you can about how to go about things is definitely a great start. Invariably people when they start doing DIY investing, they're going to make some mistakes. And I think rather than necessarily diving headfirst in and just thinking, oh, that sounds good and that sounds good, if you take that approach, you will have you're going to make more mistakes, and your mistakes will be more expensive than the cost of an advisor doing it. But then, the whole reason why actively managed funds or advisor managed investments tend to underperform is because of that expense every year. And that 2% every year compounds. 2% of fees or whatever it might be can compound over the long term. And as you showed in some of your slides, the power of compounding is very, very important. So minimizing those fees is absolutely vital. I mean, I do believe it's very possible I wouldn't be doing what I do if I didn't believe that people couldn't do it themselves. And I think that you can generate a very nicely diversified, solid portfolio of shares. Obviously using products like mine, frankly, to help you do it. But I think there are routes. There's a route from someone having managed investments, going through funds and passive vehicles like ETFs, to eventually doing it entirely themselves, picking stocks. And I personally believe owning the underlying shares is the best way to go about it. I am biased. But I think, that one of the problems, I don't know about, your ETFs and so on, but some ETFs, they can be, you're not quite sure if they actually hold the underlying shares. And a lot of them use these ETFs that track indices, actually have statistical sampling approaches to actually trying to track the index, trying to sort of copy the index return without actually owning all the underlying shares. I do worry about that. I mean, maybe, Hector, you could talk about that, because you'll know it a lot more than I will.
Well, I think, like everything, if you're going to invest in a product, you should understand how it works and what's involved in it. I mean, there's no doubt about that. I think what you're talking about there in terms of is tracking error to the index. I mean, tracking error, by definition, you can't replicate an index. So you're always going to have some level of what they call optimization. And optimization just means that the investment manager, buys a representative basket of the securities, and it might be 98% of it, it might be 102% of it. But that's not uncommon in asset management generally. So if you buy a mutual fund, you buy Woodford's fund, he's optimizing. He's not going to hold exactly what he says he's aiming for. So I think the reality is that the ETF will hold securities, it will hold assets, it will hold collateral, and it will track the index it says. But as we said before, there are websites out there where you can compare the tracking error. And one of the things you can do when you look at different issuers, you can actually look at their Eurostoxx 50 products. You can look at 5 of them, and see which one has the worst tracking error. And that could be one of the judgment points you use for which one you choose. And that, because each of them will publish an NAV daily, you can track that and you can see what the story is.
Question for the lady in the white jumper there, please, and then from the gentleman there. And we may have to draw stumps at that point, but please come and find us in the auditorium afterwards. So the lady and then the gent, and then we may have to, then time may be against us.
Hello. Could you tell me why it takes 6 to 8 weeks to move a NISA from one online execution platform to another? You have to be out of the market for that amount of time, and it seems wrong.
It shouldn't. Can you come and see us at the AJ Bell stand afterwards? Because the answer is it genuinely shouldn't do. We do have a big back.
You can do it same day, right, Russ?
We do have a big backlog of things being transferred from a small company in Bristol right now. But nevertheless, we will get back to you on that one.
Beginning with H.
Please come to the stand, sir.
Hello. I just wanted to ask, investing outside the UK in different currencies, obviously lots of stocks in Europe, etc. How do you suggest that you hedge against fluctuations in the currency, for instance, in the euro, if you're investing in, let's say, a Spanish stock?
Brenda, home territory for you, currency risk mitigation.
Well, I suppose you have to kind of look at the bigger picture at the moment. Clearly the ECB and Europe have been behind the curve in terms of trying to bring growth and ultimately investment into the area. But what we are seeing now is additional liquidity being supplied by the ECB, and that should effectively drive the euro that bit further down against the pound. The other thing is, though, because of the fact that we've had some shenanigans in the political state over here this week, it hasn't really had the same detrimental effect on the euro as you would expect, so we've seen a bit of a pop. It is possible, though, to hedge that either by using trading on the FX market directly, or I suppose in some respects just diversifying to a good degree, so ensuring that you have stocks both based in your own currency as well as in the euro, but being aware of the fact that fundamentally speaking, if this extra liquidity and potential QE comes to pass from the ECB, then the euro is more than likely going to sink a little bit lower against the pound. So the FX risk will actually be reasonably interesting to watch. So it is something that you would more than likely need to trade FX directly in order to hedge correctly.
I've got an answer for you as well, actually, because we just did some research cross-broker about FX costs, and I think a lot of the FX costs are really huge. Some of the brokers don't let you own foreign currencies, and there's some big names which don't, and they will charge you 2% on the way in and 2% on the way out, which I think is quite scandalous. But we've written an ebook. It's actually called Getting Started in US Shares, but in there is a whole section on currency risk and ways you can diversify and ways that you can sort of minimize your risk. So if you come on our stand, I can show you how to download a copy of it, which could be helpful, I don't know.
You also have the option of spread betting as well, which removes complete currency risk because you'll be trading in pounds per point no matter where that actual stock is based.
You can actually buy many ETFs now as well. They're hedged in the currency, so when you buy the ETF itself, it's already hedged in the underlying currency. If you buy the S&P 500, they'll hedge the risk, the pound risk against dollar risk for you. Or when you actually trade an ETF, if it's a foreign ETF, like say the Euro stocks, you will often get a sterling quote. Now you're not hedging your currency risk in terms of through the life of the investment, but you're certainly getting a very efficient currency transaction when you trade it on the way in and on the way out.
The clock has beaten us, I'm afraid, but please do come and find our experts on their respective stands. Thank you to all for your questions, and a big thank you to Ed, Brenda and Hector for their expertise this morning.